Introduce Jared. Come on up and give a little background to our clients on you. Welcome, Jared.
Well, thank you. Good morning, everybody. How's everybody doing? Excellent. You know, it's funny, as I was standing in the back and walking up, I thought we all have one really important thing in common this morning. None of us have any idea what I'm going to say today. No, jokes aside, as Rocky said, my name's Jared Portner. I'm the regional consultant with AssetMark, and so recently started partnering with Dan and Rocky and the team. And, you know, I tell you, I've spent 13 years in this industry, including the last 11 years with AssetMark, working with some of the top advisory firms across the country. In my early years with AssetMark, I covered some of the best firms in Texas, spent about 5 years in the Pacific Northwest, and I've spent about the last 5 years here in the Midwest, based out of Chicago, covering some of the most successful practices throughout Illinois, Indiana, and Michigan. And I have to tell you, I would be very remiss if I didn't mention how incredibly impressed I have been so far in working with Dan and Rocky and the entire team. The level of service and care, the number of services that they bring to the table, in my experience, absolutely unparalleled. Whether it's with independent advisors like Rocky and Dan, some of the larger wirehouses that I've had the opportunity to work with and even compete with, the UBSs, the Merrill Lynches of the world, highly specialized firms like Northern Trust, maybe that you've heard from. So not only are they taking extra care and attention and bringing a ton more value to the table, I'm also seeing that they do it for cheaper than a lot of these other firms as well. So it doesn't get much better than that, a better value add at a better price, right? And so I know Dan's going to come up and talk a little bit about the markets and the economies. I'm going to share just a brief story maybe as a segue into that. It's a story I heard just a couple days ago that I thought you might get a kick out of. So there's a salesman that finds a genie bottle, rubs on the genie. Now this story hits home for me. I've got a 2-year-old daughter and we watch Aladdin about 4 times a day. Okay, so yes, I agree with the face that you've made, yes. So he rubs on the lamp, the genie comes out, and the salesman says, you know, I love Hawaii, but I hate to fly, and I hate boats. Can you build me a highway so I can drive to Hawaii? And the genie says, well, that's crazy. Do you have any idea how difficult it would be to push pilings into the Pacific Ocean, the amount of asphalt, the amount of concrete that it would take to lay 2,000 miles worth of highway, not to mention the environmental releases that we would have to get in order to do that? And the salesman says, okay, well then, how about this? Why don't you just fix inflation and fix the stock market? To which the genie replies, so did you want a 1-lane or a 2-lane highway? Right? And so I think that's a good segue for Dan to come up, chat a little bit about what's going on in the markets today, what's going on in the economy. There is light at the end of the tunnel, so with that, I'll bring Dan in to talk a little bit about that. But really excited to be working with all of you and look forward to meeting you and working with you over the years to come. So thank you very much.
Thank you.
So let's welcome Dan to update us on the market.
Well. Do you mind if I put this down there?
I'll save it.
You'll save it for me? Thank you. Can I use it once in a while?
Right.
Okay, all right. Well, I want to thank everybody for coming today. A lot of information today relative to taxes and whatnot. What I'm going to get into is not a real in-depth understanding of what's going on with the market, but really focused a little bit more on where is the economy today from an economic indicator standpoint, and what is the next step or what is the next leg in the strategy to really kind of navigate what's going on with the markets today. All right, so that being said, let's start with the January speedometers. Now, for anybody, yeah, no green. For anybody who has not seen these before, the way these dials work, first of all, there's 20 economic and financial indicators. Green is good, and as Jimmy said, there's no green. Yellow is neutral, and red is negative, as you might think. Now, generally speaking, when you're looking at these, you've got hands, the black hands, and you usually have some gray hands in there. The gray hands are basically where the market was in the economy the prior month. The black hands are where they are today. So if you noticed, you'd say, Right, it's all stayed the same from December to January. And someone might say, well, does that mean things are getting better and things have leveled off a little bit? Unfortunately, we don't think that's the case. The economists we follow, really the big institutional money managers, the banks, none of them think this is over yet. Right. So what that means is we are expecting either a sideways market for 3 to 6 months minimum, or a sideways market with another downturn. So, you've heard us talk about potentially there's another 10% downturn coming. We still think it's kind of coming down the road here. We'd be happy if it didn't. Well, kind of happy, but not. Because anytime there's a downturn like that, it breeds opportunity. And the opportunity obviously comes when you're doing Roth conversions, right? Because the lower the market is when you do a conversion, you're converting a lot more IRA to Roth percentage-wise, and you get the full up of the market tax-free. So when we look at what's going on with the markets, even though we don't like this, we do like the fact that it does breed some opportunities out there. Now, as we're moving forward, you might say, well, what are we looking for before we decide to make moves in the market on the upside? Well, one of the things we're looking for is the equity market valuations turning green. Right now, they're not bad. We don't have bad price earnings ratio in the S&P 500. It's not bad right now. Matter of fact, most people might say, hey, this is a good time to get in. But ultimately, when you're dealing with institutional money managers, they want the really attractive numbers, which means there's a good chance it's going to go down a little bit further. The price earnings ratio or PE ratio is going to get better. And ultimately, that's when you start seeing the big money go back into the market. And I am here to tell you that when it comes to any kind of downturn like this in the market, there are winners and there are losers. And there's a major wealth transfer that occurs during every market cycle like this. And the transfer comes from the impatient to the patient. The patients are the ones that usually grab more and head up with a whole lot more relative to the market. So the key is really being patient and having a strategy, right? If you have no strategy, you got a problem. I think the Bible says that without a vision, the people will what? They go astray, they fall. Same thing happens with the market. If you don't have a vision, if you don't have a plan, if you don't have a strategy, there's a good chance that you're going to be in a little bit more trouble than you might want to be in. So when you're looking at this, we're looking at a little bit of change here to the upside. So this one I can see go in this direction while others continue to go on the negative side. And some of the things we're looking at is disposable personal income. You go back to really the middle of COVID, 2020, we as a nation had the highest savings rate since 1960. In other words, people were packing money away. Unfortunately, they've used up almost 2/3 of that money that they saved in the last year. So the disposable income is starting to go away at this point. So you'll see that one get a little bit negative, and when this gets negative, the consumer sentiment, and then ultimately we stop spending, and what is the highest percentage of GDP participation? It's consumer spending, 70% of it. So when that starts swinging, you might see a little more dip and a little more bad news out there. But it's not that it's going to last forever. So now let's talk about the markets as a whole when you're looking at market cycles relative to economic cycles. Now the way this chart works here is the dark blue is the market, and these are averages over time in the market, and then cycles with the economy, so economic cycles. And what you see here is both of them kind of go up together, but one being the market, tends to peak before the economic cycle peaks. Now, you start seeing some cracks in the armor for the market before the peak here, and then the market starts coming down, and subsequently, you've got the economic cycle that's going down. So that's kind of an interesting thing right there. When they hit bottom, though, there is literally about a 6-month lag between the market hitting the bottom and the economic cycle hitting the bottom. Now, this is kind of important here. And the reason is it goes back to the economic indicators. The economic indicators are forward-looking 6 to 9 months. So when they start turning positive, we're probably very close to the bottom of the market. And at that point, what do we want to do? We want to jump full into the market and make sure we're fully invested. Now, that being said, earlier this year, we made major changes with the portfolios. We've gone from growth stocks to value stocks. Why value stocks? Because value stocks stay more stable and they produce dividends. So if you have a market that's doing this, a growth stock is just going to do this on the way down. A value stock will go down, but not as much, but it'll also produce dividends, which keeps it a little more afloat. So you've seen that. We've also made changes in the portfolios relative to Astor Dynamic portfolio. In many cases, we've changed that out to the JP Morgan Value. Again, high dividend in that portfolio, and it's doing really well right now. We've also got some other things that we mixed into the portfolio to really kind of stabilize. So those are some of the things we've done in the past. Now we've also, this is something we don't like doing, but it really was the only safe haven, and that was we went to cash. So we took a portion of the portfolio, went to cash, because what was going on with bonds at the same time the equities were going down? Yeah, the bonds went down just about as much as the equities did. And that's why they're saying right now, the average person out there with a 60-40 portfolio, traditional 60-40, has had the worst year in decades because everything was going down. That which they thought was going to go up during these type markets didn't. It kind of worked the opposite direction. So we went to cash at that point with that. Now we've since gone back in, and if you have watching what's been going on, we went to cash up, we went back to equities low, now we're at a high again. So at this point, we're taking a look at it and say, well, I don't really want to go to cash again, if there's an alternative. Well, there is an alternative. It's called treasuries. When we went to cash, you might say, well, why didn't you do it then? Well, the treasury numbers were really bad back then, but they're looking kind of nice now at this point. So the yield on them is running much higher, and it's continually moving on an upscale right now. And that makes sense because inflation's going up and the Fed's raising rates. So as long as that's happening, you're going to see the treasuries go on an upward bias. So that's really our next move relative to the portfolio. So when you're looking at the stock market, we peaked up really technically in the end of December of 2021, and it's been one heck of a roller coaster ride on the way down. We came down and hit one of the supports that we felt was pretty strong. And if you go back to any of our webinars, you're going to see these numbers that were posted back 6 months ago. But the question is that the bottom? I don't think so. And could we just come back and bounce off of that and go up? That could happen. And that would be a good thing. But this is the next support level that we're concerned about. It's a pretty strong one. When you go over to the other side of the screen here in this area, you can see there was a double bounce here, and then it was off to the races at that point. So that's a pretty strong support level, and we don't believe, unless there's some kind of major thing happen, that it'll breach that. Yeah, Tina.
I had a question. I don't know if you heard with all these businesses laying off,
Yeah.
I mean, surely that'll bring, the consumer spending down.
Down.
And I think myself, my own opinion will even go further. And are we going into a recession?
Okay, so here's the
If we're not already.
yeah, here's the question. The question is, with all the new layoffs we're hearing, and we're literally hearing about tens of thousands of layoffs with some pretty big companies out there, with that happening, are we headed towards a recession? Well, you know what? We're in a recession. Anybody feel like they're not in a recession right now? They can call it any way they want, but we're in my opinion, we're in a recession. Although it might be a mild one at this point. And that's really what they're projecting. There's a greater chance of a mild recession. Oh, Floridian slip. There's a greater chance of a mild recession than there is a hard recession. But that assumes there's not something else out there, the catalyst, another black swan that no one knows about, no one knows when it's going to hit, and no one really knows how it's going to affect us. That's the black swan. And until we know that, until that hits or doesn't, we can't really make a decision on how hard this is going to be. But most believe it's going to be a relatively mild recession. Although when you tack on the inflation that we have at this point, it's a little bit of a different ballgame. And a lot of people don't understand this relative to inflation. And Jimmy, I'll get to you in a second here with the question. Relative to inflation, the way they calculate inflation today is different than the way they calculated in the 80s. Now, you understand the differences, right? Because we've all lived through the 80s with the high inflation and high interest rates. Well, if you calculated today's inflation the way they calculated it in the 80s, guess what our percentage is for inflation right now? 15%. And if you go to the grocery stores, energy, and it doesn't have to be gasoline, it's the energy that we're paying for to heat our homes, the electricity, all of that is up considerably. So they can play with numbers the way they want, but at the end of the day, I think everybody feels the inflation and the recession that we're in right now. How they're going to pull out of it, I'm not sure, but I know there are solutions. Usually common sense solutions can get you out of big messes. But when has our government had common sense, right?
Right.
I don't know.
Dan,
Yes.
when you talk about moving assets around, is it pretty much all of your clients' portfolios that you do those movements in?
Awesome question. Awesome question. It really, believe it or not, we're looking at every single client's portfolio and then making a decision of how we're going to move. So to answer your question, if we've got a client that already has a portfolio that is really high in treasuries already, we may not put treasuries in there. If we have a client that has a very large percentage of their assets in life cash value, we may not go to it because their portfolios look good already. So it really depends on each one of the client's situation before we make that move. So that's an awesome question.
So when we get those quarterly statements, you bought such and such, you sold such and such, that's what you guys are doing.
That's partly us and partly the money manager. It's really interesting the way we do things here relative to rebalancing portfolios. It's really done at 3 different levels. The first level is always exchange traded funds and mutual funds. They get rebalanced on a daily basis. The second level is each one of the portfolio managers are rebalancing within each one of their individual portfolios. And then the third level is we look at the family of portfolios, all the different things that you have, and then we rebalance back to your risk target. Does that make sense?
Yes.
That's not common in most financial firms. It is just not common. And neither is asset location investing. And if you've heard me talk about this before, asset location investing means, because we've all heard about asset allocation investing, but asset location investing really is looking at the portfolio, looking at the tax registration on the accounts, and targeting specific tax registrations for specific rates of return. Now, give you an example. If I have a IRA, fully taxed, a Roth, fully tax-free, and a non-qualified account, which is more tax-favored, so your capital gains instead of ordinary income tax. I'm going to look at those three, and I really want that Roth, the tax-free money, to be the most aggressive. Why do I want that? Because it's tax-free. That's going to give me the most bang for my buck down the road. And then next, I'm going to look at the tax-favored accounts. So that's going to be a little less risky, a little less return. And then the IRAs, which is quite frankly the biggest problem from a tax standpoint, I want that to be the least amount of return. Now, I still want to get my target average rate of return. But instead of doing what most firms do out there, which is just making all of them the same rate of return, we're going to slant it to the tax-favored side. And that makes a huge difference in what you get to spend down the road, a huge difference. And we do that, in my opinion, we do that better than anybody else out there. We literally, if you go to another firm and ask them, what percentage of the money that you manage is tax-free? Well, when you talk to them, it might be as high as 5%. Most of them are more around 2 to 3%. Our firm, just in Roths alone, are over 24%. And then you take in the tax-favored or tax-free life insurance cash value, now we're well in the 30% range. Those are big numbers, and that type numbers makes a huge difference for the client down the road. So that was a very long answer, but
That's all right.
good. All right, so let's go back to the laddered treasuries. The way the laddered treasuries work is you buy different durations of treasuries, kind of like laddered CDs. Most of us have heard about laddered CDs. Once one of the shortest treasury matures, they go back and buy an older one. And if this one matured, this one over here is probably now 3 months old. 3 months from now, they do the same thing again. So they're continually buying it that way. And again, with the treasury notes for short-term treasuries are still going up, you're constantly buying into a higher rate of return on it. Does that make sense?
Yes.
So it seeks to provide steady stream of income or growth, if you'll look at it that way, aims to provide efficiency, in other words, smooth out that choppy road we've been on, allows direct ownership of the treasury. This is a big deal. We're not buying into ETFs. We're not buying into mutual funds. We're not buying into other people's problems. We're buying directly into the treasuries themselves. That's really important because as they mature, whatever you bought, you get to reap the rewards of, not dealing with anybody else's. Now, generally, they run these things from 6 to 3 years. Now, we're shortening that closer to 15 months. And why is that? Well, because we don't think this is going to last 3 years. You know, we're 6 months or could be a year out before things really turn around. So we want something in there to stabilize. We probably will not put more than 30% in any one person's portfolio. Does that make sense so far? And what we're looking for is anywhere between net return 2.5% to 3%. Again, we're not looking for a home run. But if everything else is going down, if I get 2 to 3%, I'm pretty happy at that point because I'm securing what I still have.
That's minus fees?
That's net of everything,
Yeah.
yes.
Yeah.
And keep this in mind also, if this goes into a non-qualified account from a tax standpoint, are treasuries taxed from the federal level? No, they're not. They are state. So if you're in Michigan, you're still going to get charged 4.2%, but not federally. So it also helps on that side, okay? So when would we get in? Well, we're looking at getting into these over the next 2 to 3 weeks. So you should, I mean, if we're going to have it in your portfolio, you'll see that change within 2 to 3 weeks. But the question then is, when do you get out? There's 2 times of trying to get in and out of the market. Now we're still in the market, we're still fully invested, but how do you switch from now a treasury portfolio and move over to the regular risk tolerance or your normal risk tolerance to get that gain back up when the market does go up? Well, when I'm looking at this chart, you're looking at, let's assume that's the bottom of the market. Do you get in before the bottom or out of the bottom or after the bottom? Most people would get in after. That's okay, but you're not going to capture 100% of the upside of the market at that point. So what would I rather do? I would rather come in on this side. Now, no one's perfect with this stuff. I will just put that right out there. You can't time the bottom, and we're not trying to do that. And that's why I'm saying if we get in even 5% before the bottom, and it goes down, yeah, you take 5%, but you come back up, get that 5% back, and then you're off to the races. You're capturing 100% of what was on the bottom at that point. Does that make sense? Any questions on that?
So we're done. You take care of your family, and we will take care of you. So thank you for coming.